And we moved on to chapter 12, and we looked at issues pertaining to who is taxable. Taxable on the income. Once we looked at who is taxable on the income, we moved on and we looked at issues pertaining to what's deductible. And insofar as what's deductible, we looked at the prefacing language to Code Section 162, carrying on a trade or business, ordinary and necessary, and we put our expenditures in three baskets, right, Jiang? We took Code Section 262, 263, and 162, right? Three different code sections. We then explored Code Section 162, A1, A2, A3, dealing with what is a reasonable salary, travel away from home, and then rental expenses. So we looked at those items. The authors threw in, we threw in educational expenses under Code Section 162-5. We also looked at Code Section 274, right? We made sure that anytime we spoke of 162, we spoke of Code Section 274 and limitations on deductions. Right? So we spoke about those issues. Towards the end of the chapter, we dealt with issues pertaining to depreciation, right? Spoke about issues pertaining to depreciation, and we looked at Section 168. We saw conventions, that there are 4 different conventions. We saw methods to depreciate over the useful life. That Code Section 168, there's some other code sections to consider as well. We saw Code Section 197 dealing with amortizable expenses over 15 years. There's some good code sections or tax-friendly code sections like Code Section 179, 68K. That the code sometimes puts up limitations in the form of Code Section 280F that are not as robust, the deductions. We moved on. So once we looked, chapter 14, we spent quite a bit of time. We moved on. We then looked at investment expenses. Young, what code section is that? Don't say with a question mark. It is 212, right? Oh, Code Section 212. Code Section 212. And we know that Code Section 212 subject to limitations found in what code section? Right? That some investment expenses have to be capitalized, right? In addition, that aside from capitalization, that sometimes there's found in Code Section 274, right? Sometimes there's limitations in Code Section 274. Code Section 212, investment expenses. We also saw in the Fleischman case that you got to weigh things. Sometimes the personal attributes can outweigh the preservation or conservation of property. So in a divorce, even if you're trying to preserve or conserve property, you're really doing it for personal reasons, right? So the expenditure is not deductible. Expense under 262. We went through chapter 15 last class. We looked at things that can, and then we turned our attention, or we began to turn our attention to chapter 19. Right? And we dealt with a 4-letter word in chapter 19, dealing with issues of, right? Issues of when. I encourage you to think of this chapter of having this in 4 different quadrants. Last class, we were focusing primarily on the cash method, inclusion and deduction issues. We saw that cash method, cash receipts method, doesn't always have to be cash itself, right? Recall someone got a check December 31st after the banks closed, and we said that one of the exceptions to this rule is cash equivalent, right? Cash equivalent. Exception, Lord, is constructive receipt. Even if you don't physically get the money, if you wanted to, the fact that you don't have physical possession, but it's set aside for you, be taxable to you, constructive receipt. But if I just give you an IOU, right, Young? I just give you a piece of paper that say I owe you $5,000, but it's not mint form of payment. That will not be taxable to you. Mere evidence of indebtedness is not taxable. So that even if something is non-negotiable, but it's assignable, it will be taxable. Okay. Accountant decision. Stopped at page 605, dealing with disbursements. The line today, guys, is to finish the bulk of today's chapter, meaning chapter 19, not its entirety, and saving some room on Monday for finishing the chapter, and then you might have any to timing or anything else, because unless I'm missing something, I believe our exam is a week from today, correct? So the sand is quickly going through the hourglass. Questions logistically or substantively about anything, guys? On WebEx, although I can't see anyone right now on WebEx, but I guess it would blink if you guys had questions. So WebEx people, you're good? If you are, then let's pick up where we left off.
Actually, I have a question, Professor.
Shoot.
With the Cowden case, so he was given they were given a promissory note, and it was in like smaller parts, and they were being taxed in the overall sum of it.
Right, because it was assignable.
Okay. Okay, so they're taxing like the substance, not really the form.
Right. Because they were able to assign it and reduce that to cash.
Right. Okay.
Now, insofar as disbursements, just very briefly about that, to make sure that make it easier on taxpayers, that checks that are issued at the end of the year, even though they're not cashed, that's going to be the same as the cash equivalent. So if I pay you or pay a charity with cash, you can take a deduction in the year the check is issued. Credit card, there's a revenue ruling 78-38. The year you use the credit card to make the expenditure, even though you haven't paid yet the credit card. These are just accommodations to make taxpayers' lives easier. A case, page 608, Vanderpool case. We have this concept of constructive receipt. The concept of constructive receipt is that you're taxable again in the year in which you could have taken the money if you wished, but you just let it be set aside. Is there an analog? You know, you've heard me from day one tell you that don't look for symmetry in tax, right? That there's often asymmetrical outcomes. The concept of constructive deduction if you're a cash method taxpayer. Constructive payment. If you book deduction on your books and records? Can you take a deduction even though you haven't physically paid it? No, you can't. There is no analog. So again, one more of the many examples we have, guys, of asymmetry. Okay? There is no such thing as constructive payment if you're a cash method taxpayer. You either pay or you don't pay, right? You either pay or you don't pay. So, and I'm glad you're here today. And again, for to see come up probably in the exam, you've got to make sure that you understand there's no such thing as constructive payment. And the exam will have quite a few questions of timing. When is something suitable? When is something deductible? Boston Market on page 609. Okay, there could be a question. Questions from WebEx, but Boston Market. Suppose pay premiums. Okay, prepay your insurance premiums. Say premiums, annual premiums are $10,000 a year, and you write a check for $50,000 to prepay. You're out the cash, $50,000. Everyone agree? You're going to pay 5 years worth of insurance. Can you deduct all 5 years? Here you physically make the payment. Instincts would say no, and your instinct would be correct. Okay? You're essentially creating an intangible asset, right? Prepaid insurance that will last for 5 years. So if that is the case, deduct that $50,000 over the 5-year time period, right? You got that? Check for $50,000 for 5 years worth of insurance. You're out $50,000 cash, right, in the year 2019. But the insurance is good now for 2019, 2020, 2021, 2022, 2023 for the next 5 years, right? You have to amortize that over the 5-year period, even though you're a cash method taxpayer and you're physically out the cash. Got that? So this is another limitation on the cash method, that with respect to deductions, some of them you have to capitalize, right? There's one exception. Look at page 611. Start off with this case under the note. The commissioner, towards the bottom of the page on the far right. If you will, suppose insurance costs $1,000 a month, and today is November 1st. It's not, but let's suppose it's Friday, which is. Irvine, you write a check for $1,000 because you want 1 year's worth of coverage. It's $1,000 a month. Everyone have the visual? Cash method taxpayer. An asset that not only lasts, and he's a calendar year taxpayer. He's creating an asset that not only lasts this year, right, November and December, but one that goes through October of next year, right? Now, you might say, well, a rule's a rule. He can only deduct $2,000. The other $10,000 he has to deduct next year, right? If you're a cash method taxpayer, there's a premium put on simplicity. And Sherman doesn't really want to keep his books and records in such a fancy manner. He's not really overly abusing the code. It's not like he's doing this for a 5-year time period, right? He's just doing it as a matter of convenience. So in that instance, that Zanovich case, and then the regulations on the next page, okay? If you look at regulation 263A-4D, page 612, permit a 1-year exception. 1-year exception.
This is just for simplicity's sake. Really.
Simplicity, right? Because it does extend into the next tax year. If you look 4 or 5 lines down on page 612, Treasury memorialized the Zanovich case and says the regulations also contain a 12-month safe harbor under which the taxpayer is not required to capitalize amounts paid to create or enhance an intangible asset. The amounts do not create or enhance any right or benefit to the taxpayer that extends beyond the earlier of 12 months after the first date on which the taxpayer realizes the right of the or benefit, or 2, the end of the taxable year following the taxable year in which the payment is made. I'll give you an example. You have to capitalize, but then we had this regulation 263A-4D, right? 263A-4D. Income of the taxpayer is computed under the cash receipts and disbursements method of accounting. Interest paid by the taxpayer, okay, is properly allocable. Essentially, when you read this, over the period in which the property is borrowed. So generally, when you prepay the interest, suppose you're prepaying interest, 30-year loan, okay? You borrow $100,000, and the total interest payment is $30,000 on the $100,000 that you're borrowing. And you prepay that. You can't just deduct all prepaid interest. You have to amortize that over the entirety of the 30-year loan, right? That makes sense, right, guys? Congress just doesn't want people to manipulate expenses whenever they want, because that's not good. If you have, by manipulating expenses, you're essentially manipulating. Exception, though, that comes up a lot in our practices. Look at G2. Subsection shall not apply to points paid in respect of any indebtedness incurred in connection with the purchase or improvement. So either the purchase or improvement of and secured by the principal residence of the taxpayer, to the extent that under the regulations prescribed by the Secretary, such payment of points is an established business practice in the area where the indebtedness is incurred. The amount of such payment does not exceed the amount generally charged in such area. So in other words, you, or maybe some of you, have any of you bought your own condo or house or anything? Paducah, did Paducah? No? Any homeowners here? Motivation? What was that?
That's all I own right now, motivation.
Motivation, okay. Anyone on WebEx? Anyone own? But your parents do, and presumably your parents paid points. Could they deduct the points they paid when they got a mortgage on the house? Issue. And many of you know that if you don't pay points, points are an amount you pay up front for the loan. And the more points you pay, typically, the lower the interest rate. Okay? It's a form of prepaid interest. Everyone agree? And many homes, if you buy a $500,000 home, you can pay 3 points up in front. 3 points is the equivalent of 3%, right? 3% is $15,000. You pay that $15,000, you get a reduced interest rate. 3 points, you'll get a higher interest rate. Suppose you pay you pay points. Deduct that immediately. Now, on page 613, that's right, Carthcat case. And not surprisingly, if you look at the prefacing language, it says the only issue we must resolve is whether petitioners are entitled to deduct points withheld from the mortgage proceeds in the year petitioners obtain their mortgage. This must be amortized over the term of the loan. Taxpayers say, no, no, no. We can deduct it immediately. In this case, the IRS won. Why did the IRS win? Why didn't the taxpayer win? Because if you go to the closing, you don't in my example, where someone is buying a $500,000 house and paying 3 points, a check for 15,000, as opposed to what happened here is the bank said, "Oh, you're going to pay points. We'll lend you another 15,000, okay? And you can use that 15,000 to pay us. So now your loan's going to be for 515,000, right? If you look at the code, it says paid. It doesn't talk about that you borrowed the money, right? That you're using borrowed proceeds. That you actually have to write the check. You may say, isn't that semantics? But that's what the code says. Taxpayer loses. So when you guys go buy your house, a year or 10 years from now, if you move on from motivation, all right, then make sure you bring the check. If you're advising clients, they want to get an immediate deduction, make sure they cut the check. Everyone get the visual? 461G. And I see someone chiming in, I don't know how WebEx works because it looks like someone's trying to reach. But as long as they got WebEx and they got you guys, Sherban, you had a question?
Yes, sir. A little bit more about the check. Why cut a check?
You got to write a check or bring $15,000 in a wheelbarrow or in $100 bills. The code says paid. You can't use the borrowed funds. Hold on, just confirming, under 461F, if you do use the borrowed funds from the bank to put down a down payment on a house, there's no deduction from interest or other benefit. Well, I'm not going to say correct, Max. I'm going to say you do get a deduction, but now it has to be amortized over the time period of the loan. So if you read this case, or when you get a chance to read this case, Max, read it, and then you'll see, rather than get an upfront deduction of, I forget the dollar amounts, and they're not material, $1,600, they got a deduction of like $300 because it's over the term of the loan. So you will get a deduction, it's just longer, over a longer time period. We know deductions, right, time value of money, they're more valuable today than they are if they're spread over 30 years. All right, so Max, hopefully you got that, right? A deduction is precluded. I want to say you don't get it immediately. It's over the term of the loan. And then in Revenue Ruling 87-22, one thing you'll be humored by, maybe not, 615 is look at that interest rate. If you saw in the, after the 3 asterisks, interest rates, guys, used to be 16%, sometimes higher, because that was a very highly inflationary part of our nation's history. That's why we now have a Federal Reserve Board to try to keep interest rates, monitor interest rates. So that's not the Treasury Department using their imagination. That's the Treasury Department reflecting the reality of the times. And someone refinanced their house, and they borrowed $100,000, $80,000 to refinance, and $20,000 for an improvement to their house. The question was, with respect to the points, what could they deduct? And if you look at the language of the code, to 461G, prepaid interest, it talks about for the purchase or improvement of a principal residence. It doesn't refer to refinancing. So only that portion of the borrowed money, which was 20%, which related to the improvement, was deductible, okay? Only the portion relating to the improvement was deductible. The other portion, the other 80% was not. Guys, that gives you, again, the cash method, for exam purposes, I'm going to tell you, consider bringing a yellow magic marker, blue magic marker, whatever you want, red pen, blue pen, to circle. Because you're going to have to identify, is the person on the cash method? Theoretically, the cash method's easier of the methods, but we can see now that there's some exceptions. Take a look at the problems on page 617. Lender lends out money at a legal rate of interest to debtor. Debtor is required to pay $5,000 interest each year on the loan, which extends over a 5-year period. The interest deductible by debtor under 163. The agreement calls for payment of each year's interest on December 31st of the year. Both parties are calendar year cash method taxpayers. We're going to discuss what are the effects, right? So let's look. Okay. Checked for $5,000 interest to lender on December 31st of year 1 is delivered to lender on January 2nd, year 2. You guys can do it your own way. I have it down as lender. Identify this as inclusion issues, deduction issues, right? Loan identification, and let's just go around, see if we agree in this room. Role play. I always think role playing is a good thing here. You're the debtor. When do you deduct? And Maduka, you're the lender. When do you have to include? When do you get a deduction? Year 1 or year 2? You're writing the check. When do you write the check, hon? You say year 2. Right? When do you get a deduction in year 1? We have a revenue rolling. That revenue rolling 54-465. You should get a deduction in year 1. Yes.
I thought it said that you get in the taxable year in which the check is delivered.
Mailing is the
Okay.
important part.
Okay, so it's not when it's delivered, it's when
No,
it's mailed.
it's not. Nothing says delivery because, let's face it, many people mail checks at the end of the year. They don't. Do you know when your checks are delivered? No, you do know when you mailed it. You don't know when it was delivered.
Oh, so the lender would come.
It would come in with respect to writing it. Loosey goosey, because you know and I know some people write charitable checks the first week of January, dated, backdated. But you don't want to be doing that or telling your client to do that, right? Right. Okay, where people have Apple phones that can record you in a heartbeat, and you don't want to be looking like fraud, right? Included, Maduka. The people on WebEx can't hear you. By year 1. Your thought process. Receive it. Where do you say that? You're the lender. When do you receive it? Great. To include it? Yeah. You didn't even know it was in the mail. Did you? You heard Han said it's in the mail, but you know what's the 3 biggest lies in the world. You're going to see this in a week from now, so you better know this. Not because I'm saying it threateningly, I'm saying it in a way I want to see you guys do well, so don't just blow this off. Your exam after your exam tomorrow, then you can blow it off until tomorrow. How's that? Give you permission. Debtor mails the check in A above on December 30th of year 1. Delivered to lender on December 31st of year 1, but after the banks are closed. Justin, when do you get a deduction? Jiang, when do you have to include it?
So you get the deduction in year 1.
Year 1? Jiang, when do you have to include it?
I think.
The receipt, is that the rationale, guys? The case we looked at,
The collar.
collar case. When did he receive the check? 31st. When did he receive it? After all the banks were closed. You have to include it? Yes, Justin, you're not getting me scared. Don't.
It's included. Once he gets it, he has to.
Hey, no one talked about it being honored.
And you said
Don't
the
make
case
it
was
up.
Cowden?
K-A-H-L-E-R, the first case in the
Oh, got it.
chapter.
Because a check is like basically as good as cash.
Cash
receive it.
equivalent,
Yeah.
not Jiang constructed receipt. Fine, but I'm just making the observation, and if you're working with a client or a supervisor, right, it's not necessarily getting it where people are gonna smile at you, because if you use the wrong concept, people are gonna call you out on it. Tough world out there, right, guys?
They say it's included in year one by Kaler case.
Yeah. Gives lender a promissory note in December 31st of year one, agreeing to pay 1 year's interest plus $50 on January 30th of year two. Debtor pays off the note on January 30th of year two. Okay? So, in this case, Kyle, when do you have to get a deduction? And Han, when do you have to include it? I apologize. Irvine, Paducah, you get the honors. Irvine, when do you get a deduction? Paducah, when do you have to include it? For the debtor, you owe the money. We don't even care because I don't mean that bad. I should have. Remember, you're the debtor, right? You're the one looking for deduction. Doesn't he? The question is, did you pay the cash? And the answer is no, right? Definitely year two. Year two. Yes.
In this case, can I mention that this case is problem is related to no constructive.
Well, you're right. There is no constructive payment. Vanderpool.
So Vanderpool, right?
Right. You have income? Year two. Right? Year two. Like that, but yes, Williams was mere evidence of indebtedness, right?
Right. Okay.
No, this was not going to, he did not receive a cash equivalent in year one. The pay lender the $5,000 interest due on December 31st of year one, but lender suggests that debtor paid January 2nd of year two, which debtor does. Okay? So when do you get a deduction? And Jiang, when do you have inclusion?
During as a debtor.
You're the debtor for the moment. You owe the money. When do you get a deduction?
I get the deduction in year two.
Year two, everyone on that page? Yeah, that's when he makes the payment. Everyone agree? Keep on WebEx, make sure you agree. You don't see it. Your silence speaks volumes that you agree. Disagree. It just goes off.
No, it's, I think they said agree, yes.
Yes, okay. It's on that page. So, Jiang. What year?
I think year two.
Fine.
He receives it year two.
You for a reason. What was that reason, Justin? The receipt, Jiang. Could have taken the money.
But how do you, but
If I give you the money, you hold on. I need the visual on this, Jiang. You're watching me? Turn my back. Or you turn your, if you offer me money and I turn my back on the money, that's the same as if I got it, right? You say, Sola, take this money. I'm paying you. I could have taken it, right?
Then two, 'cause-
No, there's no such thing as constructive payment.
Okay. No, I understand.
That's constructive receipt. Everyone understand this is constructive receipt. The money was there, ready for the pickings.
Professor?
Yes, sir.
So, I mean, I think Justin has the same question. How does the IRS know that you have a constructive? This kind of confusing me.
I mean, sometimes it's a fact pattern. Like if we took the football player, Horning, and suppose he chose, like, he got the car, just make it up, December 30th instead of the 31st. and it was down the block from him, okay? And they gave him the key, but he didn't pick the car up for 3 more days until after the New Year's. He would probably say, no, it's taxable in year 1. He would say, no, it's taxable in year 2. Ours would say, no, you had constructor receipt. You had the car keys. The dealership was open. You should have picked up the car. The fact you didn't doesn't mean it's not taxable in year 1.
Okay.
Everyone agree? Sometimes you'll see that. Where in a contract, I write it out. I send you an email that says, I'm willing to pay you on December 10th, and you write an email back to me and say, no, I don't want that much income this year. Pay me after the new year. Well, the IRS says, can you send us all your emails? And there's an email trail that says, with the person offering you the money and you saying, no, thank you, that's going to prove problematic. A debtor pays all 5 years worth of interest to lender in cash on December 31st. Okay? So, debtor, Justin, when do you get a deduction? Han, when do you get inclusion?
Have to deduct it across all 5 years, so 5,000 every year.
5,000 each year? Everyone agree? What's your authority?
The revenue, was it the revenue ruling? 8722?
No, it's actually the code. 461G, right? It says that generally interest has to be amortized over the period. Prepaid interest has to be amortized over the period, right? Of borrowed money is lent.
Like to both debtor and lender?
Well, Han is going to tell us. What do you include and how much? Why?
Well, because the IRS wants.
Not the IRS.
Oh,
Congress.
Congress,
IRS doesn't
yes.
write the law.
Inclusions they want.
Are they justified?
Yes, because he does receive the payment.
Han, shouldn't this person be taxed on $25,000? They received $25,000 of cash, Han. Can they go to Atlantic City that night and spend it all? Can't they? Yes, they can. What's to stop them? Han, why can't they go to Atlantic City and gamble on red or black? $25,000 of prepaid interest right now, Han. What's to stop you from going to Atlantic City tonight? A good time if I'm the U.S. government. When do I want to talk tax on? Do I want to tax him today or over 5 years? Do I want to wait until maybe Han goes bankrupt? He spends it on nefarious things and terrible things, or drugs. We can paint a parade of horribles, right? When's the best time to tax someone? When they have liquidity, right? Should be taxed on all 25,000 day one.
And revenue ruling 87-22, it only applies to points.
That only applies to deductions. We're talking about inclusion issues. Max agrees, 25,000 in year one. I hope you agree now. You agree? The rationale? GAAP purposes, we would probably take this over 5 years, right? But tax and GAAP function on 2 different wavelengths, right? Different purposes. This violates all your GAAP principles, right, guys? Same as E, except the debtor does so because the lender makes it a condition of extending debtor another loan. So I'm not going to worry about question E. It just talks about even if it's going to produce the same outcome. Even if he makes it a condition of the loan. Question G. Years 1 interest, $5,000 of cash in January 2nd of year 2, and as agreed, pays year 2 interest December 31st of year 2. Paying a little late, and question is, When does debtor get deduction? And when does lender have inclusion? Justin, when do you get the deduction? And Shervon, when do you have inclusion?
I think, all be in year 2, or is it?
You can ask me, I'm the client.
I can't tell if it's spread out or.
Well, the payments you're making, put yourself in this sentence, you're making 2 payments both in year 2.
It's the equivalent of like technically F, right, where you're making 1 payment for 5 years.
From the prior year and the current year.
It's not like prepaid,
It's not prepaid at all, it's a late pay.
All right, so then
Post payment.
so then all in year 2.
Pretty great, yeah.
Yeah.
Just-
leaving your hands in the same.
Right. Paid interest is late payment. And Shervon, are you the person for inclusion? When you receive the cash, all 10,000. Good? Let's do the next problem. See, this is to lend itself to multiple choice questions, right, guys? Render services to client which are deductible to client under 162. What results to both lawyer and client? Cash method calendar year taxpayers in each of the following circumstances. Lawyer sends out a bill for $5,000 on December 24th of year 1, and I'll add parenthetically, miraculously pays the bill by January 5th of year 2. Okay, so we have a lawyer. Let's assume this is an ordinary necessary business expense. It's deductible, the lawyer's including it, right? Set a bill for $5,000 November 15th, client immediately pays using her Amex card, and 15th, and client pays Amex on January 15th. Does client get deduction? When does lawyer have to include? You get deduction, Jiang, when do you get?
Client gets a deduction when he pays the credit card bill in year 2.
All right?
Agree, because when you have when you make a payment with a card, you already have increase of debt. So I mean, you already paid the lawyer at the time, but by using from the credit card, right?
Right.
So I mean,
Don't we have a revenue ruling on this point? Dash 38, right? Which says that it's the year you use your credit card, which is deductible, Justin. Of inclusion?
same with I think it's year 1.
What do you think year 1? The money.
Money, yeah.
Not a tough question, right?
I thought you had other tricks.
No tricks up my sleeve. The services, lawyer and client agree that lawyer will be paid $2,500 in year 1, $2,500 in year 2. Client pays lawyer $2,500 in year 1 and $2,500 in year 2. Deduction if you're Ravon and Paducah, when do you include it?
Deduction in year 1.
The client will, right? When does the client get the deduction? Makes 2 payments, he gets the deduction in those years, right? So year 1 and year 2, right? Author's hoping to illustrate by this problem. You should know. What are the authors trying to illustrate by this problem? Problem C. Book. Illustrate, right, Young? Is that if you negotiate up front when the payments are going to be made, there's no constructive receipt. if they negotiated payment for year one after the services were rendered and said, you know what, pay me, instead of paying me, even though the lawyer says you owe me 5,000 right now, pay me 2,500 now, pay me 2,500 later, that would be constructive receipt of the entire amount. But if you negotiate up front before the services are rendered and payment is made accordingly, there's no constructive receipt. Everyone see? Everyone can see the distinction? It's 2,500 each year one and year two. Maybe that was the previous. All right. Calls lawyer at 4 p.m. December 31st of year one, saying she has lawyer's fee payment. It's made out of check in the full payment. She's about to leave for Europe and will leave the check to the desk clerk at client's apartment. Lawyer is ill, has no one to pick up the check, finally picks it up January 2nd of year two. Client get a deduction. His lawyer have income. Question, right? Everyone agree?
Well, both in year one, right?
Why do you say year one, by the way?
He sent it technically.
Did he send it?
Well, in theory, right? If he leaves it.
Well, that's the tough part. We all know you put something in the post office box, that's considered sent. Everyone agree? You guys, I mean, it's kind of funny. My son, this is how little, my son is in his very early 20s. Where do I find a mailbox? No clue what a but the notion is you got to mail something, right? But here, this person did not leave it with the lawyer's. If the person left it with the lawyer's secretary, right, that's an extension of the lawyer. You would say it was delivered. Here, the client is leaving it with their own person. It's like it never left their possession. Everyone agree? Hard to say in this case. Now look, guys, let me also, so you don't drive yourself nuts, make for a good multiple choice question, okay? This is a challenging question. There's no clear answer. Notwithstanding that the authors gave us a case citation, you can read that case. I've read the case. I can't understand how to apply it. It's not really this fact pattern. So it's nice the old lawyers, if you see at the end of this case, they cite to this Luce versus U.S. 1934 case. Resemble the fact pattern they're describing. But putting that issue aside, it's hard to say that this client should get a deduction in year one. I would argue probably the better answer is year two. The lawyer theoretically picked up the check, right? Picked up the check, or had someone pick it up. It would tell us, hey, that has the aroma of being constructive receipt. They could have picked up the check. There's a possibility here. Look at this. Now, I'm not saying this is the right answer with a capital R. It could be constructive receipt to the lawyer in year one, not deductible until year two by the client. Perfect answer? I don't know if there's a perfect answer when you get such a messy fact pattern. So, if you want to leave, just so that a question mark or two next to it, I don't want to say that's the final unequivocal answer. It's just accurate, right? You guys know that? Used to, as accounting students, when to accrue income, when to accrue a deduction. Spring City, page 619. You perform services for someone who then owes you money. Let's say $100,000, Shervon, you're performing services for someone. They owe you $100,000, but they're questionable whether they're solvent enough, they'll be able to pay you next year, right? There's some issues, solvency. They may or may not. You have to accrue it in this in year one, even though their solvency is questionable. And that's what Spring City says. We don't want taxpayers to make judgments whether or not they'll get paid and decide to take money into income based on their judgment call. So if you decide the person is insolvent and you write it off and you're not going to try to collect it, then you don't have to accrue it. But if you think there's an opportunity here, you have to accrue it in income, even though obligor may have questionable finances. Only 2003-10, there's several issues here. Events of 451, when does the taxpayer using accrual method accounting accrue gross income if the taxpayer ships goods, the customer disputes the liability of the taxpayer because of a clerical mistake in the sales invoice discovered the next taxable year. So suppose you ship goods and your client disputes that they owe you money. They say there's a mistake. You have to accrue it in income. The ruling says no. But if you ship the wrong goods, the customer disputes the liability. You have to accrue that. Yeah, right? Wrong goods because legitimate dispute. Part 3. Suppose you ship the goods, ship more goods than the customer ordered. The customer asks that for a makeup provision next year. The taxpayer will reduce quantity of what they get next year. You have to accrue that, and the answer is yes, right? Because you're not challenged. They essentially say they owe you the money, and next year they'll just get less goods. Summary of the law here for accrual method on page 621. Under law and analysis, the second full paragraph provides rules for determining the taxable year of items of gross income, relates to regulation, and under the accrual method of accounting income is includable in gross income. All events have accrued that fix the rate, and the amount thereof can be determined with reasonable accuracy. All events that fix the right to receive income occur when 3 conditions are met. Performance takes place, the payment is due, or the payment is made, whichever occurs first. On page 622, there's an analysis, and we get the conclusion. I just summarize. On page 623, Tax Act added something. You accrue it for financial accounting purposes. Look at that, page 623, 8 or 9 lines down says, thus an accrual method taxpayer generally may not report an income item, financial statements, and defer inclusion of that item for tax purposes. If you accrue it for GAAP purposes, you have to take it into income for tax purposes. Take this. The taxpayer physically got the money in 1917. It's challenged in the taxpayer's hands. In other words, there was someone else who was challenging whether or not the taxpayer had a legitimate right to that money. But the taxpayer, in the meantime, could have done whatever it pleased with the money. The question is it taxable when you physically get the money, or years later when the issue is resolved and it's determined legally to be yours? Do you include it the year you physically get the money, or the year it's resolved that it's actually yours? In the court case here, this is a U.S. Supreme Court case, and it gave rise to what's known as the claim of right doctrine. And this is spelled out on the bottom of page 625. Page 625, 8 or 9 lines from the bottom of the page. The taxpayer receives earnings under a claim of right, which I circle claim of right, and without restriction as to its disposition, is received income which he is required to return. Required to return means required to report. Even though it may still be claimed that he is not entitled to retain the money, and even though he may still be a judge liable to restore its equivalent. This gets to the point I was raising before. Claim of right doctrine, if you physically have possession of the money, you have to report it. It was a 10-year lease. They got paid year 10 in advance. Here you go. A 10-year lease, and the renter pays year 10 rental due in year 1. Purpose is, right? You wouldn't accrue that into income until year 10, right, Han? What? To do with it under North American Oil Company? Reportable? Physically have it. You have it.
He paid year 10, only year 10 years.
He paid, no, just year 10.
Then we would deduct year 10.
Deducted until year 10, even if he's a cash method taxpayer. Full year taxpayer. In this case, it was the Tampa Ray, Tampa Devil Rays. Did I say that right? For baseball fans out there. Tampa Bay Devil Rays. This is on page 629. How many, since the World Series is tonight, I should know this. Season starts April, right? April, May, August, September, October. Let's say baseball season 7 months. Suppose, Justin, you're a sports team owner of the Tampa Devil Rays, okay? And you get paid $7 million of advanced ticket sales. Okay, everyone have the visual? Justin's the owner. It's paid $7 million, and they're in a fiscal year, and the tax year ends in May. Okay, $7 million to report it. Under North American Oil, you would say he has to report it when? Versus, doesn't it make sense? He got $7 million essentially. May, $2 million, $1 million per month. April, May, June, July, August, September, October, and he got really $5 million for year 2. Everyone agree? What happened in this case, right, is that the taxpayer argued on page 629, that the taxpayer received that and wanted to report it over 2 years. Who prevailed? Page 629, the third full paragraph, you have 4 lines down. 2 notable decisions involve major league teams, which are attributable to the later taxable year. In those cases, the taxpayers were able to sufficiently demonstrate that the earning events playing the games were certain enough to permit the prepaid income to be deferred and matched with related expenses. In that case, the monies, we knew when these games were going to be played, right, Justin? You knew. But for possibly a rain game, we knew with certainty when that income was going to be earned, right? Everyone agree that there's no, well, maybe some of it's going to be earned in year 1, some of it is going to be earned in year 2. It's not clear. You knew with pretty much exact certainty when it was going to be earned. Case under Code Section 451. If you look at code, let's look together at Code Section 451. 451A. Amount of any income of gross income shall be included in the gross income for the taxable year in which received by the taxpayer, unless under the method of accounting used in computing the taxable income is properly accounted for as in a different period. You see that latter language? The court relied on that and said, look, it was the proper period in which that should have been accounted for. the service threw in the white flag. If you look at the bottom of the page, revenue procedure 2004-34, permitting limited deferral in the case of prepaid services and the regulations related thereto. 15 years ago, service did permit exception. Well, Congress took action and said, you know what? Taxpayers were looking, say, suppose Justin got paid 5 years of advance sales, right? And we knew when those gains were going to be paid. People were saying, you know what? Let's extend that and let's report that over 5 years. Well, Congress decided in 2017 to curtail that and said, you know what? We're going to put a limit here that the most you could defer is up to 1 year. So that was a question mark. When I taught this course over the years, clear how much taxpayers could defer over what period of time. Well, the 2017 Act ended that question mark. In 451C, it elected to defer it up to 1 year. The accrual method, 451C now as an exception. Everyone see that? If you're a taxpayer with inventories, you have to be on the accrual method, generally. I have studied inventories. I'm sure your gap, you can handle this very elementary discussion of inventories. Getting on page 633, there's an exception. First, put in an exception for small businesses. And if your gross receipts do not exceed $25 million to the contract for the provision of services, the services are not provided until the following year. In other words, right, you sign your name to a contract obligating yourself to pay X dollars, but the services are not performed until the following year. And you accrue a liability in the year you execute the contract or the year the services are actually performed. For exam purposes, and it's not the exception. I just want to operative rule here. Section 461H, 3, the fourth paragraph down on page 635. 461H, the regulation, provide that for purposes of determining whether an accrual method any amount of liability is incurred, the all events test is not met any earlier than the taxable year in which economic performance occurs with respect to the liability. Economic performance is a sine qua non, is an essential feature of securing any deduction. You need economic performance before you can take a deduction. That makes it year 2. Execution of the contract is not sufficient to establish the liability. You need economic performance before something is deducted. Schuessler, page 637, if you sell furnaces. If you sell furnaces. And just to make up the number, normally when you sell furnaces, or someone else does, dollars for furnaces, charge $1,500. Why do you charge $1,500? Because you pay the people service each year for the next 5 years the furnace. That's part of the payment arrangement. You deduct the $500 that you're obligated to perform these services on behalf of these folks. Can you deduct the $500? And the answer is no. Well, the taxpayer wins here, okay? Because if you look at the date of the case, 1956, the all events test is met. That's, if you look at code section 461, which we should, under 460, for purposes of this title and determining whether an amount has been accrued with respect to any item during the taxable year, the all events test shall not be treated as met any earlier than when economic performance with respect to such item occurs. So in addition to meeting the all events test, where the liability is actually arisen, where when you sell your furnace, you actually have an obligation to perform certain services, not be met unless there's actual economic performance. So the authors include page 637, this case, but this case would lose in 2019, okay? Everyone understand the taxpayer would lose because now it's not enough that you agreed to service the furnaces, you actually have to service the furnaces. So the authors are giving us a taste, a glimpse that the law used to have a lot more latitude for taxpayers to take deductions. 461H is much, much more restrictive. You can read that for yourself, and you can see it puts to bed a lot of issues. Now, here we go, guys. Now these are accrual method taxpayers. So different rules apply, so be very careful. Render services to a client, which are deductible to the client under 162. Lawyer sends the bill for $1,000 on December 24th of year one. Client pays the bill. So what do you have for client? When do you get a deduction? Jiang, do you agree? Taxpayers are client. Accrual of cash. They are both calendar year accrual method tax. Justin would want to circle the word accrual for exam purposes, right?
And for the exam, it will say in the problem.
Well, but then don't assume anything. Better write it out. When do you have to money, legal rate of interest? Debtor is required to pay $5,000 of interest here on the loan, which extends over a 5-year period. Interest is deductible by debtor under 163. Agreement calls for payments December 31st of each year. The loan is made on January 1st of year one. Both parties are calendar year. Justin, you'll appreciate this. Accrual method taxpayers, right? All right, so December 31st, debtor's having serious problems. When does debtor get a deduction? In this case, we'll see if I could do this in some semblance of order. Justin, when do you get a deduction? Jiang, when do you get inclusion? Have inclusion, Jiang? Justin's having financial problems. He's accrued in income because his rights, Jiang's rights, have become fixed to earn it. He's earned it. So remember, under Spring City, even if the payor, meaning you, Justin, is having problems, doesn't matter. So it's year one and year one. Jiang, you look nervous.
Yeah, I thought that was wrong.
B. 31st of year one, debtor does not pay the interest because of legitimate disputes over debtor's obligation to pay the first year. When you get deduction, when do you have inclusion? In this case, do bear in mind that the revenue, first of all, you don't get a deduction, right? You don't get a deduction if you say that you don't have to pay it. Because that's saying rates have not been fixed. So if you're saying that you don't have to pay it, why should you be allowed to accrue a deduction? There's a revenue ruling 57-463 to include it because all your rights have not been fixed. So there's no deduction in year one. There's no inclusion in year one, Shervan, because notice the phraseology the authors use. Because of a legitimate dispute. No deduction because we haven't met all the requisites under the test. You're disputing that you owe the money, and the recipient may not collect because presumably not all events have happened which fix the right to payment. It's not perfect, last I checked, unless you know the contrary.
What was the regulation again?
It's not a regulation, it's revenue rules.
Oh, revenue.
The deduction side is 57-463. The inclusion side is revenue ruling 70-151. To be above, if the lender includes the December 31st interest in an applicable financial statement, the lender says, you know what, I'm going to accrue this in income anyway. It's included in the financial statement. New code section, just under the 2017 Act, under Code Section 451. 451C. Included in your, for GAAP purposes, guess what? You're going to include it for tax purposes. That's going to be year one. It's going to be year two for debtor. Because debtor still says, hey, I don't owe you the money. So that throws into question whether it's not. But if the lender is including it for GAAP purposes, it says you got to include it for tax purposes.
No deduction though, or it would still be year two.
I'm going to say no deduction, assuming it's year two if they resolve it in year two.
Yeah, that's what I
If
was.
they don't resolve it, it's not year two. So I'll put year two with a question mark, or I'll put if resolved. It's hard to figure out.
I'm sorry.
No, don't apologize. I'm like you. I would like to be responsive, but all right, sure, bud.
I have a question, sir. So let's say it's resolved in year 3, and you have the obligation to pay,
Right.
so he'll have to back pay all those years,
Meaning he'll take the deduction in year three.
but he'll have to pay.
Remember, he's taking a deduction in year three, so he's going to get the deduction in year three. He doesn't have to do any admitted returns.
So how about for year 1 and 2? Will he get?
What do you mean? Will he get the? If he's throwing it into dispute, he can't deduct the interest payments until year three. It's clear that he owes the obligation. Where the debtor is proven that he doesn't. Maybe this is a usury rate. Okay, the lender is charging usury that negates the debtor's obligation. And if the court agrees, the debtor may never have to pay the interest, may never get a deduction.
Work for the inclusion side then. It never pays.
And
Back it out.
the lender can file an amended return or take a loss for the year that if the statute of limitations is already lapsed on year one. Legitimately disputes the obligation to pay years one interest. The debtor does pay it, and then in year two sues to recover it. The visual, this time Maduka in hand. Maduka owes on interest, right? But Maduka says, I dispute it. I don't think I owe it, but I'm gonna pay it anyway, and I'm gonna sue you. Han, you get the interest, but Maduka is gonna make a claim to get it back. Maduka, when do you get a deduction? If Maduka contests an asserted liability, if Maduka then transfers money or other property to apply for the satisfaction, and the contest with respect to the asserted liability exists after the time of transfer, but for the fact that the asserted liability is contested, the deduction would be allowed, and the deduction shall be allowed for the taxable year of transfer. Maduka, you can take it in year one. What's your authority? Code section 461F. Still, when do you have to include it? Year one, right? Because you can go to Atlantic City, right? Pays year one $5,000 of interest January 2nd of year two. When do you get a deduction, Justin? When do you have included? What about question F? Everyone think hard about question F. Most people on WebEx, do you get a deduction? How much? And anyway,
I think it's year 1 through 5,000 each.
Yeah, same.
why is that?
Because when they first made the contract, they had agreed to 5,000.
Paid interest, right?
Yeah.
You can only deduct as it accrues. Everyone agree? Talked about when he gets a deduction. Now we have to talk about inclusion. What would you include?
25.
You would include that under what? An oil Supreme Court case, claim or right. Okay? But, okay, there's a but coming. Under the new code, the Devil Rays case, but we also now have Code Section 451. C4, take a look at Code Section 451. C1. Take 1 year into income and take the balance in year two, right? Election is made, what happens? 5,000, you're one. Now, so the answer, Shervon, is both. It could be either. Depends if the taxpayer made an election or not. Of teaching tax or practicing taxes, nothing ever stays the same. Right? Things are always in flux, guys.
So do you think like that provision will stay in?
You know, look, Congress acts for a lot of different reasons, right, Kyle? Sometimes there's revenue driven, or sometimes there's an ambiguity in the law, and Congress wants to address it. So it seems to me this is a logical rule. So I think this is going to be here for a while. I don't want to say the word forever because forever is a long. You guys have an exam tomorrow. Let me just say this. If you look at question 3, it brings up a question very similar to question 2F. Take a look at that. Let me call your attention to question 4. And Justin, you'll appreciate this more than most, or everyone here will appreciate this. Question 4 is a good question. Why? Because it deals with someone who, on one hand, there's one taxpayer who's an accrual method, and another taxpayer who's a cash method. So you got to be very sensitive because all of a sudden, on an exam or with clients, they may not be all cash method, they may not be all accrual method. So now, that doesn't make the problem necessarily harder, but you got to use your right quadrant to come to the right conclusion, right, guys?
Will this kind of mixed question be on the exam as well?
Yeah. Okay. It may or may not, but let's presume it will be. Okay. Sometimes, remember, as we've read throughout this chapter, you've been able to choose what kind of accounting method you want. If you look at the last segment of the chapter, notice its title, Forced Method of Accounting. Is that in some instances, the code is going to force a particular method of accounting. The taxpayer is not going to have a choice. So, class, rather than get too far ahead of ourselves, and given the fact you guys need an extra 5 minutes for your exam tomorrow, I'll try to be magnanimous here. Those people on WebEx, you're going to earn an extra 5 minutes to perform well on tomorrow's exam. Let's leave it at that. Any questions? Now, keep in mind, Monday, guys, needless to say, we're not going to go the full session, but I strongly encourage you over the weekend. You have no other exams next week but mine. Over the weekend, if anyone has any questions, please, on Monday, bring any and all your questions because that's a good time. We should have a good hour to address any and all of your questions.